All right, this is your exam review for exam 3 in accounting 6302. Um, so I've got a number of problems here to go over with you. These are of the type, not necessarily exact numbers and that you'll see, but these are the types of problems that you will see. This chapters 14 and 15 are heavy on standard costing, flexible budgeting. There's going to be a lot of variances that need to be calculated in this. So let's get into it. Um, we see it, and I've sent out um, these problems to you also, so you'll have them to look at and go over and practice. Okay, so we've got Miller has the following information pertaining to its direct labor in a recent period. The total direct labor hours used is 22,000. Total units manufactured 7,200. Actual wage rate was $15 an hour. Then we have standard cost data of the wage rate per hour. The standard is $14 an hour, and the standard hours per unit of output was 3 hours per unit of output. Okay, so um, the way you set up this is a standard costing problem. It's looking for the direct labor efficiency variance and the direct labor wage rate variance. And so the way you set this up, this is you put the actual in this column. You put over here on the other side, put this down. On the other side, you put the standard. And this is also the flexible budget. And I think that sometimes confuses students that the flexible budget and standard costing, the standard is the flexible budget. Then what you have in between, well, let me break these down. The actual has the actual quantity. It doesn't matter whether you're using materials or labor. Um, the actual quantity times the actual rate. And over here we have the standard quantity times the standard rate. In between, we have a mixed column, and it is the actual quantity, so the A from over here times the standard rate. Now, we don't use this column much other than in standard costing, but what this actually is, this is a flexible budget based on inputs. Where this is the standard flexible budget over here, that's based on our outputs. This is based on our inputs here. So now we have this format set up, and we just start filling in numbers. So we've got 22,000 here times an actual rate of 15. Those are both given to us up in the narrative. We can bring this actual quantity of 22,000 over here. We have a standard rate of 14 here, right? And then we have an actual quantity. Well, the standard quantity is 3, but remember this is the flexible budget, so it's 3 times the 7,200 units that we made times the 14, right? So the standard is 3, but that's for 1 unit, and we made 7,200 of these. And so what we need is 7,200, 3 times 14 times would be 302,400. That's how much it should have cost us in labor to make 7,200 units. Then over here on this column, we've got the 22,000 actual hours times the $14 standard rate is 308. And then over here, we've got the 22,000 times the 15 gives us 330,000. Now we compare these, the labor efficiency variance. So the efficiency variance is this one. See, the rate is the same. It's only the quantity that changes. So this is the efficiency variance here, right? And you want the one on the right is bigger, that is favorable. So this is the one on the right is smaller, so that is unfavorable. So that's 5,600 unfavorable. So that's number one. The rate variance, see, the quantity is the same, but it's the dollar amount it's different. So this is our rate variance. And again, the one on the right is bigger, it's favorable. One on the left is bigger, it's unfavorable. So we've got 22,000 unfavorable here. This is number two. And then we want the summary journal entry that goes into this, right? And so we're going to have the work in process is going to be this actual amount, or I'm sorry, the standard amount for standard costing, 302,400. We're then going to have labor efficiency variance. If it's unfavorable, it's a debit. So that's 5,600. And labor rate variance, and that's 22,000. And so then we get wages payable of 330,000 right here. So it's this one is the standard that goes into work in process. This one is the actual that goes to wages payable. And then these favorable or unfavorables we fill in so that our equation balances. All right, so that takes care of the first one. Okay, the next one we've got number two. The McElroy Company has prepared the following master budget for 2021. Although McElroy has a capacity to manufacture 50,000 units, management expected the likely demand for its product to be 40,000 units in 2021. As such, it prepared the master budget to manufacture and sell 40,000 units. In early January 2022, the company was pleasantly surprised to find out that it manufactured and sold 45,000 units. Grab a piece of paper. And so we've got all of this going here. This is our master budget on all of that. Okay. And then it says prepare the flexible budget for the actual operating level achieved in 2021. So what we're going to do is we will take that in our sales. So we'll take the 2,800,000 and divide it by the 40,000 units. So our selling price was $70 a piece, and then we multiply that times 45,000. And so our sales would have expected to have been 3,150,000. Okay, then we go into our cost of goods sold. Direct materials are variable, so that's 800,000 divided by 40,000. And I'm going to store that 40,000. We're going to use it a lot. Divide that, that's $20 a piece, and we actually made 45,000. I'm going to store that one as well. And so that would be 900,000 for direct materials. Okay. Then we come on direct labor is 300,000. Divided by 40,000 is $7.50 a piece. It was 337,500. Then we've got the indirect materials is 24,000. Is 60 cents a piece. So that would be 27,000 for indirect materials. Indirect labor is also variable. Divide that by 40,000 and multiply it by 45,000, and we get 40,500 for indirect labor. All right, depreciation, we normally treat that as fixed unless it's units of production. It doesn't say that. So depreciation is going to stay the same, 300,000 on that. Salaries, same thing. Salaries usually indicates, these are not workers on the line. These are like supervisors and such. So those are usually fixed costs, or 200,000 for that. Then we got utilities, which are 80% fixed. So the utilities I'm going to divide into two. So 80% of 100,000 is 80,000. So that's fixed. And then utility part two is going to be 20,000, the variable part. Divide it by 40,000 and multiply it by 45,000 is 22,500 for that. Maintenance is 40% variable. So that means it's 60% fixed. So maintenance, the fixed part, is going to be 30,000. And then maintenance, the variable part will be 20,000 divided by 40,000 is 50 cents times 45,000 is 22,500 also. And so we add this all up. We get 1,960,000. So our gross profit is going to be the $1,190,000. Okay, and does that make sense? Yes, our gross profit under the master budget where we sold 40,000 was 990,000. We're a little over $1 million. That makes sense. So then we proceed on with our commissions. That's going to be 5% of sales, 3,150,000. times 5% is 157,500. Advertising is fixed at 150,000. Wages are variable. Oops, I wrote variable instead of wages. All right, so wages are variable, so 100,000. Divide that by 40,000 is $2.50 per unit. Multiply that by 45,000 is 112,500. And rent is fixed. Rent at 50,000. That gives us our total operating expenses. Is 470,000. Giving us operating income of 720,000. All right. So that takes care of our second problem then. Hey, number 3, we have the Falcon Company uses a standard cost system. As such, all inventories are carried on the books at standard cost. During the most recent period, the manufactured 12,000 units. The standard cost sheet indicates that the standard direct labor cost per unit is $1.50. This performance report for the period includes an unfavorable direct labor variance of 1,000 and a favorable direct labor efficiency variance of 275. So what was the total cost of direct labor during the period? So we just set it up like we do all of these. This is our actual, and that's what we're trying to find, right? So we've got over here, the standard is going to be 12,000 units, and the direct labor cost per unit is $1.50, so that's going to be 18,000, right? That's our standard. Now, our direct labor efficiency variance is 275, and that's favorable, so we know this one is bigger. So that means that this is minus 275. So this is going to be 17,725. And we know that the rate variance, an unfavorable rate variance, so we know this is smaller, so we add 1,000. And so we come up with 18,725. So that's the cost of actual direct labor used during the period. Okay. Number 4. James has the following information pertaining to his usage of direct labor in a recent period. Total direct labor hours worked was 30,000. Total units manufactured was 8,000. Actual wage rate was $16. Standard wage rate was $18. And we need 4 hours per unit. So just multiply these out. Is 480,000 was our actual wages paid. $18 an hour, not 18,000. Be 576,000 would be the standard wages paid. So now we're going to have the 30,000 times the 18 here. That's 540,000. So the efficiency variance, because it's based on the hours, is this one. And that's going to be 36,000. One on the right is bigger, so that's favorable. The labor rate variance is going to be 60,000. Again, the one on the right is bigger, that's favorable. And prepare in proper form the journal entry to record the wage expense for the period. So this one's the opposite of the first one that we did, where we had unfavorable variances, right? So here we're going to put this in at standard. So we've got work in process, 576,000. Then we'll have the labor efficiency variance will be 36,000. We'll have the labor rate variance, and that's 60,000. And then we'll have wages payable, 480,000, like so. Okay. And so that's our journal entry for that one. Number 5. The Chin Company uses a standard cost system. As such, all its inventories are carried on the books at standard, not actual cost. During the most recent accounting period, the company had the following summary transactions. We purchased on credit direct materials. The standard cost of these materials was $32,000, while the actual cost was $30,000, while the actual cost was $32,000. So number 1 is the purchase of direct materials, and that's going to be raw materials inventory, direct materials inventory for $30,000. We'll have this will be a materials price variance, and that's unfavorable because we paid more. The actual would be on the left, and that would be 2,000, the difference between 32 and 2. And then we would have accounts payable would be 32,000, the actual amount. Okay. Then number 2, we issued in production for materials. The standard cost of materials that should have been issued for this period's output was 35,000, while the standard cost of materials used in production for the period was 33,000. Okay. So number 2 is going to be work in process inventory. And that will be the standard cost was 35,000. Then we're going to have a materials usage variance of 2,000. And then we'll have the raw materials inventory for 33,000. And that's number 2. Number 3, we had actual direct labor cost, which has been incurred but not yet paid for the period, was 75,000. The standard direct labor cost for this period was 80,000. The direct labor efficiency variance for the period was 10,000 favorable. Okay, so what we want to do on this one, I think what we want to do is draw our little map. The actual labor cost is 75,000. Remember, actual goes here, and the standard cost for this period was 80,000, and the efficiency variance was favorable, so that makes this 70,000. This is the efficiency variance. That means this is the rate variance, and that's going to be 5,000 unfavorable, right? Because the one on the left is smaller. Okay, so now with that, we can go forward. Okay, so 3 is going to be work in process inventory, and that will be for the 80,000. Then we will have the labor rate variance of 5,000. We'll have the labor efficiency variance of 10,000, and then wages payable of 75,000. You can see we've got 85 here, 85 here, and so we balance and we're good. Go back up here to number 4. For the units completed during the period, the standard direct labor cost was 78,000, while the standard direct materials cost was 34,000. Okay, for the units sold during the period, was 76,000. Okay, so the labor and materials cost associated with finished production in this period. So we had the standard, so number 4, right? Labor cost was 75, so 75,000 divided by 80,000 equals be 93%. Times 78,000. Maybe 73,125 for the labor. For the materials, we had well, direct materials cost was 34,000, so we have 33,000 divided by 35,000 is 94%. And we multiply that times the 34,000. So that would be 32,057. That's for 4 for the production, and then 5 sold during the period. We're going to do the same thing. 30,000 times 0.9428. 5 would be 28,284 for materials, and for labor, would be 71,250 for labor. All right, so that's number 5. Number 6, Chemical Incorporated has set the following standards for direct materials and direct labor for each 20-pound bag of weed be-doom. So you need 25 pounds of XF 2000 at 8 cents a pound is $2. Direct labor is 0.05 of an hour at $32 an hour for $1.60. The company manufactured 100,000 bags of weed be-doom in December and used 2,700,000 pounds of direct labor hours during the month. The company purchased 3 million pounds at 0.075 per pound and incurred a total payroll of 182,000 for direct labor. Company records purchases at standard cost and therefore recognizes material price variances at the point of purchase, compute the price and usage variance for direct materials, and the rate and efficiency variance for direct labor in the month. Okay, so this one we end up with two in that middle column. So the actual purchase was 3 million pounds times 0.075 per pound. Would be $225,000 is what they actually spent. We're going to take that 3 million pounds here and multiply it by the standard per pound, which is 0.08. And that would be 240,000 pounds. So the material price variance is going to be 15,000 favorable. All right. During the period, they used 2,700,000 pounds. So here's our second column, 2,700,000 pounds of that. This is times the 0.08. Is 216,000, and it should they should have been 100,000 bags times 25 pounds per bag times 0.08. So this 0.08 is the same. And we get 200,000. here. And so our materials usage variance is 16,000 unfavorable. Okay. Then we want to do the rate and efficiency variances for labor. We incurred a total payroll of 182,000. Now this time we only end up with one middle column, right? Because with the materials we calculated the price variance at purchase and the usage variance at usage, right? So here we're going to do it all at usage. And so we encountered 182,000 for direct labor. We made 100,000 bags. It should take 0.05 hours. And that is $32 per hour. Okay, we had 5,200. Oops, 5,200, not 52,000. Direct labor hours times $32 per hour. So now we just multiply those out. 166,400. Okay, so this is our efficiency variance, and that was 6,400 unfavorable because the one on the left is bigger. And this is our rate variance, and that's going to be 15,600, also unfavorable there on that. Okay. So now it asks us to do the journal entries to record the preceding events. Okay, so at the time of purchase, we're going to have raw materials or direct materials inventory at 240,000 pounds. We're going to have materials price variance of 15,000 and accounts payable for 225,000. That takes care of that one. Then we need this one. We had work in process inventory is going to be 200,000. We're going to have the materials usage variance of 16,000, and then we're going to have raw materials inventory for 216,000. So that takes care of the raw materials. We're going to have then the journal entries for the labor. Okay, so we're going to have the work in process inventory is going to be 160,000. We will have the labor efficiency variance of 6,400, the labor rate variance of 15,600 and wages payable of 182,000. So, all right, so that's number 6. Number 7, Erie Company uses machine hours to apply cost to production. The following data, compute the following variances using machine hours as the activity variable to assign standard overhead cost to production. Show calculations. All right. So our the units produced were 2,500. The total machine hours is 100,000. So we need 40 machine hours per unit. Right. And our cost per machine hour, total variable overhead cost is 250,000 divided by 100,000. Machine hours is $2.50. So our standard would have been $250,000. The total variable overhead cost incurred was $265,000. I did this wrong because our budgeted data was, we actually did 2250. All right, so 2250. The other two are right. So that would be 225,000 there. Total machine hours was 96,000 times $2.50. It's going to be 240,000. So our efficiency variance is 15,000. And our rate variance is going to be 25,000. This is unfavorable. This is unfavorable there. Okay. Then we have the fixed overhead spending variance. Well, the fixed overhead cost incurred was 54,000. Now this is a little bit different because this is going to be the budget, which is 50,000, right? But this is going to be the applied over here. And so we 50,000 divided by machine hours is 50 cents per hour. And so the amount applied was 96,000 times 0.5 is 48,000. And 48,000. All right. And so the fixed overhead spending variance was 4,000. Unfavorable. The production volume variance was 2,000. Also unfavorable. Okay. Number 8. The bike pedals manufactures bike seats. The company budgeted to manufacture 25,000 seats in April with 0.05 standard machine hours per seat. Total factory overhead was budgeted at 30,000 for April. During April, the company manufactured 30,000 seats using 1,600 machine hours. It incurred 34,000 of variable factory overhead costs. Okay. So determine the variable overhead spending variance. So the standard is 0.05 hours per seat. And they budgeted for 25,000 times 0.05. They budgeted for 1,250 hours. So they had 30,000. So that would be $24 per hour. And it turned out that they made 30,000 seats. I think I said 24, right? Let me do that again. 25,000 seats times 0.05, 1,250, and they budgeted 30,000. Yeah, 24. Okay. So the standard was 36,000 in variable overhead. They actually used 1,600 machine hours times 24. Would be 38,400. And they had 34,000 in variable factory overhead. So this one is going to be the rate or the spending variance. And so that's 4,400. This is the efficiency variant. This is favorable, by the way. And this is going to be 2,400 unfavorable there. And the flexible budget variance is just the total variance here. Remember, this column is the flexible budget, right? And so they've got 2,000, and that is favorable. Okay. Number 9. ABN Corporation has following information about its standards and production activity in May. So they had 55,000 variable overhead incurred, 40,000 fixed overhead incurred. Variable overhead is $4 per unit. The fixed overhead is $3.40 per unit. Denominator activity level is 13,700. Actual units is 14,000. Okay, so the variable overhead fixed budget, the flexible budget variance would be 14,000 times 4 we get 56,000, and our actual incurred was 55,000. So our variable overhead flexible budget would be 1,000 favorable. Okay, the fixed overhead spending variance, the incurred was 40,000 over here. The actual fixed overhead was 340 per unit times a denominator activity level of 13,700 is going to be 46,580. So the spending variance was 6,580 favorable. The production volume variance was 14,000 times 340 is 47,600. Be 1,020 favorable. Okay, and so each of the three variances. Well, we made more. Our variable overhead came in actually pretty close. The 40,000 was actually lower than was budgeted, and then we produced more than budgeted, so we had quite a favorable variance there. Okay, number 10. Ben Simon Corporation has the following information about its standards and production activity for the month. Variable overhead is 31,350. Fixed overhead is 25,000. This is exactly like the problem we just did before, except the numbers are different. And so let's see what we end up with. The actual variable overhead is 31,350. The standard overhead rate is $3.10 per unit. The actual number of units during November was 9,600. Would be 29,760. And so the flexible budget variance is 1,590, and that will be unfavorable. With that, okay, the actual fixed overhead came in at 25,000. Here we're going to do the standard is $2 per unit, and the denominator volume is 12,000, so that would be 24,000. So that's our spending variance is 1,000 unfavorable. We've still got the $2 per unit, but now we made 9,600. That's going to be 19,200. That's 4,800 unfavorable. That is the production volume variance. Again, the reason these came in less is because we had the lower volume than was anticipated in the budget. Okay. Got the quality cost reports. 4 accepted categories of cost of quality report are prevention, appraisal, internal failure, and external failure. Assume your cost management and structure is giving you assignment, or you are to relate each of the cost categories above. Give an example of prevention, internal failure costs you might encounter. So prevention might be studying what goes into a cost of quality report. Appraisal, let's see. Appraisal might be grammar checking, your report. Internal failure would be having someone else look for their conundrums that grammar check doesn't pick up on. And then external failure would be having your professor find typos. Okay. Number 12, identify the cost of quality category for each one. Engineering time spent to simplify production processes. That would be prevention. Engineering time spent engineering change orders to reduce the number of components used in a project. Actually, let's make that one appraisal. That would be prevention. Scrap resulting from substandard materials, that's internal failure. Rework, that's internal failure. Preventative maintenance on machinery, that's prevention. Product inspections, that's appraisal. Air freight to replace a defective part by a customer, that's external failure. And long distance call to a customer who has experienced quality failure, that is external failure. All right. And then our last one of these, listed below are 6 concerns of quality, and we want to classify those. Establish a 24-hour hotline for customers to report quality failures, that is external failure. Establish quality inspection program, that would be appraisal. Redesign parts and components to simplify, that would be prevention. Hire additional field service people to provide better services. I'm going to go with internal failure. Extend the warranty period for products from 90 days to 1 year. That I'm gonna go with external failure, although honestly that one's a little iffy to me. And then train employees, that's prevention. Extending the warranty, why are we extending the warranty? Is it because our products are so good? I don't know. So I'm honestly a little mixed about that one, but the rest of them I'm certain of. All right, so that is your review for this third exam. Good luck on it, and I wish you all the best.